Hello, everyone, and welcome. My name is Lori Santikian. I'm a professor of finance and strategy here at UCLA Anderson School of Management and the director of the UCLA Fink Center for Finance. On behalf of the Fink Center, the UCLA Ziman Center for Real Estate, and the UCLA Anderson Forecast, I'd like to extend a warm welcome to all of you joining us from around the world as we dig into the ongoing upheaval in the banking system. Almost 15 years following the 2008 banking crisis, investors, regulators, and market participants had grown complacent to potential risks building in the banking system. All of that changed on March 8th, when Silicon Valley Bank, a regional bank in California that catered specifically to the technology industry, announced that it would book a $1.8 billion loss after selling investments to cover increasing withdrawals. A few hours later, Moody's downgraded the bank. 2 days later, the bank collapsed, marking the second largest bank failure in U.S. history after Washington Mutual's collapse during the height of the 2008 financial crisis. In the days that followed, more bad news came. Signature Bank, another mid-sized regional bank, became the third largest bank failure in U.S. history on March 12th. Within 10 days of Silicon Valley Bank's failure, Credit Suisse was taken over by UBS. And now, just over the weekend, federal regulators seized First Republic, and JP Morgan Chase acquired the bulk of its operations. This now makes First Republic the second largest bank to fail in U.S. history. There are a lot of questions about how we got here and how much more pain is on the horizon. For our discussion today, we're privileged to welcome 4 faculty and alumni experts from UCLA Anderson. Shohini Kundu is a professor of finance at Anderson, whose research focuses on financial intermediation, regulation, corporate finance, and macroeconomics. Stuart Gabriel is a distinguished professor of finance and the Art and Realty Chair at Anderson. He is also the director of the UCLA Ziman Center for Real Estate. His research focuses on real estate finance and economics, housing and mortgage markets, urban and regional economics, and macroeconomics. Jerry Nicholsberg is a professor of economics and the director of the UCLA Anderson Forecast. He plays a key role in the economic modeling and forecasting of the national, California, and regional economic forecasts produced by UCLA Anderson. And Chris Myers, from the class of 1991, is the former CEO and president of Citizens Business Bank, one of the 10 largest bank holding companies headquartered here in California. Thank you all for joining us. So let's start. Let's start with how we got here. Shohini, could you please help us understand typically what conditions can precipitate a bank run, as well as the root causes of this particular banking crisis?
Sure. So let me first talk about what the problem is that banks are facing today, and then I'll provide some context for what happened to Silicon Valley Bank. So since the aftermath of the pandemic, the Federal Reserve has increased interest rates to fight inflation. And since January 2022, the Fed has raised short-term rates by 4.75%. This is significant considering that short-term rates were incredibly low for several years. And in fact, the federal funds rate was 0.08% just in January of 2022. So when the Federal Reserve increases the federal funds rate, it also influences longer-term interest rates. So what's the problem here? Well, first, a key function of banks in the economy is that they provide funding, and they do this by taking deposits and then investing it. Typically, banks fund long-term loans and securities with short-term deposits that they get from people like you and I and corporations. So if you or I suspect that our bank isn't doing so well, and we are uninsured depositors who face the risk of losing our deposits, we'll go to the bank as fast as we can and we'll demand our deposits. Now, because the bank has already taken our deposits and invested it towards long-term loans and securities, the bank is going to have to liquidate those assets in order to repay us. So the core issue that banks face today is interest rate risk. As interest rates rise, the market value of their long-term assets decrease. And to provide some context, this is exactly what happened in the savings and loan crisis of the late 1970s and early 1980s. So S&Ls were essentially small banks, and the joke was that they were a 363 industry. So this meant that they took money in at 3%, they lent it out at 6%, and they were on the golf course by 3 p.m. What happened was that in the 1980s, interest rates had increased as Paul Volcker tried to fight inflation. And so all of the long-term loans that the S&Ls had granted at fixed rates had actually yielded much lower interest than the rate at which the S&Ls could borrow. And as interest rates increased, depositors also demanded higher deposit rates. So to make it clear, after interest rates were raised, S&Ls were essentially borrowing at 8% and they were lending at 6%. And that's not really a profitable business. So what did they do since they were going under? Well, many of them issued very risky loans with this hope of gambling for resurrection. So essentially, they were throwing Hail Mary passes by undertaking super risky loans with a very small probability of success that they would be made whole. And of course, this didn't work, and it actually made a bad crisis even worse. So they say that history doesn't repeat itself, but it rhymes. And what we're seeing now echoes what happened in the 1980s. As interest rates have increased, the market value of banks' assets have decreased. And with Silicon Valley Bank, initially, the bank didn't recognize their losses because there are accounting rules that don't force banks to mark their assets at market value if they plan to hold those assets until maturity. So initially what happened with SVB is that as economic activity was slowing down, companies weren't making as much in payroll, many startups were strapped for cash. So naturally, they went to the bank to withdraw their deposits. Now, as a result, SVB was forced to sell their securities in order to pay back their depositors. And in the process, they had to recognize $1.8 billion of losses. So what that means is if you look at the balance sheet, there's a hole of $1.8 billion on the asset side that SVB needs to plug in if they want to preserve their balance sheet. So to plug the hole, they planned a $2.25 billion equity offering. What happened instead was that some prominent venture capitalists told their startups with uninsured deposits to pull out their money since SVB was close to insolvency. And that's what ended up precipitating a run. So we can do a post-mortem analysis and look at what went wrong. First, SVB was fundamentally insolvent because interest rate risk materialized and they didn't end up recognizing the losses because of accounting rules. Second, even if you have insolvent banks, you don't always have a bank run. In fact, if you have insured depositors, then the insured depositors don't have the same incentives to run as uninsured depositors. So accounts that are $250,000 or below are insured so that even if a bank is failing, an insured depositor is less likely to run because they know that the government's got their back and the government has guaranteed their deposits. At SVB, over 90% of deposits were uninsured deposits, and this is exceptionally high, and that's what precipitated a run. A third key difference is that SVB had a relatively undiversified portfolio of assets and undiversified funding source. So SVB was highly exposed to interest rate risk on their asset side. And on the liability side, they were the bank for startups and VCs. Their depositors operated in the same tech ecosystem. They were on the same social media platforms with the same channels of communication. And this amplifies the run because all the depositors were talking to one another via the same platform, which was Twitter, and they knew what everyone else was thinking at the exact same time. So if depositors are dispersed and diversified, not everyone would behave in the same way and trigger such a rapid run. So to put things in perspective, the run on SVB is the fastest in human history. SVB collapsed in just a matter of hours. They lost $42 billion in 8 hours. And the previous largest bank run was Washington Mutual, which experienced withdrawals totaling to $16 billion in 10 days. So it gives you a sense of how technology had really magnified and accelerated the speed at which this run had occurred. Now, aside from the lack of diversification, a fourth issue is rapid growth. SVB's deposits grew from $49 billion in 2018 to almost $200 billion in 2022. And mirroring the growth in deposits, its asset growth also experienced tremendous increase. And their asset growth tracked the IPO cycle. So it tells you that their assets weren't well diversified. Now, anyone can tell you that if a company is rapidly growing, it can put strain and it can put stressors on a company. So risk management really becomes crucial. SVB didn't have a chief risk officer for 8 months after their chief risk officer resigned last spring in April of 2022. Now, aside from analyzing what SVB did, what they didn't do, the business model, there's a fifth issue which relates to regulation and the importance of regulation. The Dodd-Frank Act had required banks between $100 to $250 billion in assets to hold a sufficient amount of high quality liquid assets to cover net outflows during a stress period. Now, what happened was that the previous administration eliminated these rules for banks below $250 billion in assets. And SVB was actually well below the liquidity threshold that would have applied if it weren't exempted because of the previous administration's elimination of the rule. Now, in addition to this, the previous administration also reduced the obligation for banks like SVB to undergo stress tests from once a year to once every 2 years. And in fact, SVB had not undergone a comprehensive capital stress test in its history. Now, if we ignore SVB and look at the large banks, even among the large banks that did get stress tested, the Federal Reserve didn't anticipate that rates would rise above 2%. The highest interest rate that the Federal Reserve's 2022 stress test considered was 2%, which is well below the over 4.75% that we have today. So let me just stop there, but that provides some context behind the turmoil that we're experiencing in the banking industry.
Thank you, Shohini, for that in-depth primer for everyone to understand how the banking system works and what led to some of these tensions. Chris, you've been on the front lines of these issues for decades now. Can you expand further on the core issues, including placing this particular crisis in historical context for us based on your experience?
Sure. I guess I can give the practical side of this, and for someone that was in the chair, and just so everybody knows, I retired 3 years ago, and I announced my retirement in the summer of 2019, and my official retirement date was March 15th, 2020, which was, as you remember, the first day that the world closed down due to COVID. But I recall very, very distinctly in 2018 and 19 the lowering of interest rates, and thinking, what's going on here? What's this? What are the long-term ramifications that go along with lowering interest rates? And all of a sudden, banks became great deposit gatherers. And historically, you grow your deposits 3, 4, 5, 6% a year, but banks were growing double digits. And as Shohini pointed out, Silicon Valley Bank, almost quadrupled their deposits. So what happens is so you're running a bank and you have all this extra money come in, and banks are very, very simple in the sense that on the asset side, you have investments and you have loans. And on the liability side, you have deposits and borrowings. There's a whole bunch of subsets to all of that, but the bottom line, that's pretty much it. And so what happened is banks got flush with deposits. And so they sat there and said, what are we going to do with these deposits? And the options were to put them overnight with the Federal Reserve and get 25 basis points, 0.25% yield, or to go out the yield curve. And so they tried to do that with loans. And if they couldn't do that with loans, they did it with investments. And so they bought securities with historically very low interest rates. For instance, I think the rate on mortgage-backed securities got below 2% for a 4 or 5 year duration. So then all of a sudden, January 2022 comes and rates flip. And so the banks are still holding a lot of these investments at 2%, yet rates are now, overnight rates are going from a 25 basis points to where they are today at 5%. So if you're borrowing money or attracting deposits at 4 or 5%, and you've got securities on your books at 2 or 3%, you're underwater quickly. And that's really what has happened. And a lot of the banks, I mean, I can tell you from a regulatory standpoint, yes, the banks have all the interest rate sensitivity models. They have consultants going in all the time. And you look at these, okay, what happens if the world got shocked by 200 basis points, 2% or 3% or 4%? And all these models will tell you what happened. But I think a lot of the boards just didn't believe it was going to happen, and they felt like they had to put the money to work. And now we're seeing the flip side of that.
Well, so after the sale of First Republic to JP Morgan, Jamie Dimon suggested yesterday that the market turmoil that was set off by SVB's collapse was at an end. He said, this part of the crisis is over. Other investors are not as convinced. Seems like markets are not as convinced. Short interest remains strong in banks. Today, PacWest and Western Alliance, for example, led a big sell-off in regional lenders. Both Shohini and Chris, how worried are you about further vulnerability in the banking system, and what metrics are you paying attention to as you assess that?
So I think Jamie Dimon's point is really getting to this question of whether this risk was idiosyncratic or whether it's a systematic risk that's affecting a number of banks. So Silicon Valley Bank is not unique. There are many banks with large interest rate exposures that also have large unrecognized losses on their investments. Some of these banks are hedged against interest rate risk, others are not. And that raises questions regarding bank solvency. It's like Warren Buffett said, only when the tide goes out do you discover who's been swimming naked. The accounting rules mask the true level of losses. And so it's imperative to have accounting rules that reflect the market values of banks' assets so that the losses are recognized on banks' balance sheet. And, relatedly, bank capital has been declining since 2017. This is not something that's just unique to a single bank, but we can see it in the aggregate trend. So if the unrecognized losses were embedded in bank capital and we had mark-to-market accounting, bank capital would actually be even lower and suggest that banks are not as well capitalized as they previously were. So we shouldn't wait for stuff to hit the fan before we react. And in terms of further vulnerability, SVB may have been the bank for Silicon Valley, but there are certainly other regional banks that face similar high concentration risk and concerns of contagion. So there are undiversified depositors and undiversified assets. So if you take First Republic Bank, for example, they have been heavily concentrated in real estate. First Republic Bank was known for handing out interest-only mortgages and offering extremely low interest rates to borrowers with high income and credit scores. And these borrowers didn't have to pay principal for almost a decade. So essentially, the bank issued jumbo mortgages, which are long-term loans, to customers with high credit demand. Demand for these loans increased during the pandemic, and First Republic's assets doubled within 4 years. And this was an extremely profitable business when depositor rates were essentially zero and the banks were getting 3 to 4% on their jumbo mortgages. But now with rising interest rates, its mortgage book has dropped in value, which has raised concerns about solvency. And then there are other banks which also have high levels of uninsured deposits, which can also precipitate a run. That includes Signature Bank, Citibank, Comerica, in addition to SVB and First Republic. And the main concern is not just about runnability risk, but it's about contagion spreading across banks because of a fear factor and lack of trust in the banking institutions. And now with social media, everyone is communicating with everyone else and everyone knows what everyone is thinking, which can increase contagion and runnability issues. So those are some of the things that I'm concerned about going forward.
Yeah, and I would add to that, remember, so a lot of these loans that are out there are fixed rate loans, but they're not fixed rate to the maturity. So you may have a mortgage that amortizes over 30 years, that's fixed for 5 years, and then reprices after that 5 years. And so what's going to happen is we're going to see that these mortgages, as they do come to reprice, the rate is going to go up, which is a good thing for the bank, right? The yield will be higher. However, now you have borrowers that were underwritten at the lower interest rate. So if you assume they were the underwriting for the banks was at 4%, and now the rate's 8%, well, that's a big cash flow strain on the borrower. It's the dynamic shift, and we're going to hear a little bit in a little while, I think, from Stuart about some of the real estate side of that, because I think if you're saying, is there going to be another wave? That could be the next wave. Is all of a sudden borrowers who were borrowing very cheaply are going to be repriced on their borrowings, and we'll see if property values hold up.
Mm-hmm. Jerry, if we could turn to the economic outlook for a second, what does all of this mean for the economy, both regionally and nationally? What kind of risks are you worried about? And then later, let's talk about Fed policy.
Sure, but I think I want to start with Fed policy, at least with the increase in interest rates. As Shohini said, the interest rates have been going up, and they've been going up sort of in the way that they went up in the early part of the Volcker increases, and which precipitated the S&L crisis. And we've been seeing that kind of very rapid increase in interest rates. And the idea of Fed policy is to cool off the economy, and is to cool off the economy by causing contraction in interest-sensitive sectors. So that's business investment, that's in residential and non-residential real estate, that's in autos.
Mm-hmm.
However, it hasn't been working because business investment is up, including fixed investment in structures in the aggregate. It's mixed across classes, and Stuart will have a lot more depth on that. Business investment is up. Automobile production is up. It looks like the housing market has bottomed out. And so the economy is growing, and we have very low unemployment. So what do these interest rates increases mean for the Fed slowing inflation? Well, inflation is coming down, but kind of not in the same way as one would expect. And in the Volcker years, the interest rates had to go up triple what they have so far, right? So it looks like the outlook is fairly strong. Now, how does the financial sector and this banking crisis kind of feed into this? In two ways. One is interest rates have not responded to the banking crisis, but something has to give because there's higher risk. And what is giving is tighter lending standards. And that's equivalent to very dramatic increases in interest rates. Those tighter lending standards might result in a reversal of those trends that I was talking about of the growth in the economy. So that's a risk, but the economy has proved to be very resilient in the face of the interest rate increases thus far. So that's kind of an open question. And I think the second open question, and maybe the more important one, is that the FDIC, the Fed, the Treasury learned from September 2008, don't let Lehman Brothers go under again. They didn't learn from the Volcker years about taking interest rates into account and how it would affect the financial sector. So it looks like maybe they've stabilized it. But what we don't know is what systemic risk exists in the non-bank financial sector. And is that systemic risk such that it's going to feed into the banking sector? And it is 2008 all over again. So that's a risk and something that we need to look at. So those risks of tightening credit standards and the potential, though we don't know, it is definitely an unknown, the potential for systemic risk are the things that we worry about in terms of the economic outlook. People have pointed to, just one other thing on the regional, on the California, people have pointed to the layoffs in tech and how that's going to disproportionately affect California. It turns out that the layoffs in tech are disproportionately outside of California, that this is all the growth that we saw. Tech is moving to Austin, it's moving to Nashville, et cetera, et cetera. A lot of that was back office or lower salaried employees who were moving out to remote work. That's where you're seeing the bulk of the layoffs. And in fact, tech employment measured by professional, technical, and scientific services payroll employment, is growing in California. So I think that, there is some risk here, but we're not seeing in the data any sort of implosion in tech that you would expect with Silicon Valley Bank going under.
And so, sorry, Chris, go ahead. Please add.
One quick thing. I wanted to just ask Jerry a question, I guess a panel member asking another panel member a question. But so inverted yield curve, right? We've had, everybody says a recession usually follows an inverted yield curve. We've had an inverted yield curve for a while. I mean, what are the ramifications having of an inverted yield curve for this long? Do we know what's going to happen there? Explain what an inverted yield curve is too.
So that's a great question. That's when the long rates, let's say the 10-year rate is now below the 2-year rate or the 3-year rate. So that's an inverted yield curve. Now, if you look at the last 11 recessions, and that's a very small sample, you see that yield curves invert before the recession. But they invert sometimes 18 months before, sometimes 2 months before. So the correlation there is really not very good. That's the first thing. The second is we're in a really different environment in this post COVID lockdown 2020 recession environment. So the economy has changed. Big shocks like a pandemic will change the economy, and our financial system has changed, right? The way we do payments, as Shahini said, the very fast run on the bank. And so we have a small sample. People say they're associated with recessions, maybe, maybe not. So I think that we really don't have the causality between the inversion of the yield curve and a recession.
And Jerry, so as we think ahead to the path of interest rates, the Fed governors are going to gather tomorrow to begin discussing their next moves. How do you think that those discussions are going to go? Do you have any forecasts on where things are headed over the short and medium term?
I don't have a forecast of what they're going to decide. When Silicon Valley Bank went under, there was a lot of discussion of maybe the Fed will take a pause in interest rate increases. And they came out and they said, we think we've solved the problem, so we're not going to. And they raised interest rates 25 basis points. This is the very short-term interest rate, the Fed funds rate. So they're going to have the same discussion this time. And the market is predicting that the FOMC members are going to decide that they'll raise interest rates by 25 basis points. But that doesn't mean that they will do that. They seem to be moving to the point where they're going to say, we're going to take a pause in our increases in interest rates and see if inflation really comes down based on everything that we've done in the past. One thing that I think is fairly clear, at least they're trying to telegraph this, and the market is not believing it, but they're trying to telegraph that once they take a pause, they're not going to be lowering interest rates anytime soon. The market is pricing in that they're going to be lowering interest rates within about 6 to 8 months. So that's a differential in what Wall Street thinks the Fed is going to do and what the Fed thinks they're going to do.
Stuart, so Chris already previewed this, but one of the concerns about banks' balance sheets right now pertains to commercial real estate, particularly loans for office and retail properties. And as most of us read, Charlie Munger, for example, is warning of agony in the sector and a brewing storm from U.S. banks' exposure to what he says are bad loans as property prices fall. Can you help break this down for us? What are you worried about, and are there any reasons to be hopeful?
Sure, Lori. Well, thanks everybody. And we've had a lot of good commentary so far, and welcome to everybody. Just maybe I'll take a step backwards before taking a step forwards. So clearly we were bitten by recession that came out of the COVID period, came out of the pandemic, was associated with supply chains and changes in demand patterns that we didn't anticipate. The Fed has acted. We anticipate 25 basis points tomorrow. We anticipate perhaps a pause after that 25 basis points. But that 25 basis points, if it materializes tomorrow, is a full 500 basis points in terms of upward movement in short rates, what we call the short end of the yield curve. That's a massive movement. What we do know about monetary policy is that it has unpredictable, variable, and sometimes long lags. And so we're not really sure how and when the patient is going to respond to the medicine. The medicine today is coming, and Jerry mentioned this, not only by way of your traditional tightening on the short end, but the medicine is now coming indirectly via what's going on with this sort of rolling, percolating banking crisis and some of the credit tightening that pertains there too. No one knows how to put a number on the credit tightening that pertains to this set of events in the banking industry, but it could be worth another percentage point or two in terms of Fed tightening. And if so, the Fed has additional reasons to pause because they really must see how this all plays out. And then we have yet another wild card, and that wild card is truly wild, but it relates to the debt ceiling. We have very odd things going on in the Treasury market currently, where there's a flight to purchase very short-dated Treasuries, putting downward pressure on short rates as concerns mount with respect to the debt ceiling, and the Fed has to take all of that into account. Now, what I thought I'd do is sort of break down some of the debt rates that relate to real estate and talk about some of the consequences. So the Treasury yield curve, the set of Treasury yields as are manipulated by monetary policy or monetary policy seeks to manipulate through quantitative easing or conventional policy or whatever, that's the beginning of the story. Those are called risk-free rates. And on top of those risk-free rates, we have risk premia. And those risk premia relate particular sectors and particular points in time and particular geographies. We can talk about risk premia that relate to real estate. And in the case of certain sectors of real estate, for example, in the office sector, those risk premia, as are embedded in nominal rates, have gaped out very substantially. So if you look at a mortgage rate on a commercial real estate loan, or if you look at a mortgage rate on a residential loan, or basically any other sort of interest rate, you can roughly say, as a rule of thumb, that that rate is the sum of the risk-free rate plus the risk premium. So what we have today in the case of commercial mortgages, for example, is that we see substantial upward movement in nominal rates, reflective both of risk and of the activities of the Fed and all the rest. And what are the implications thereof? The implications are higher current mortgage rates, both residential, non-residential. And that, of course, means reduced loan qualification, reduced loan extension, great difficulties with respect to loan refinance that we'll come to momentarily, and changes in demand patterns that, among other things, reduce property values. But let me go on from there and say the following. These changes in risk-free rates, the upward movement and the upward movement in risk premium, also get embedded in what we call discount rates that are used to value future streams of payment as are pertinent to either mortgage payments received by banks on the commercial side, on the residential side, or whatever, or with respect to actual real estate equity, that in the form of property. So that with higher discount rates and higher what we call capitalization rates, we are seeing marked reductions in the value of mortgages and mortgage-backed securities that are held on the books of financial institutions, and similarly with respect to the equity or the property itself. Now, the most concerning sector here, and I'll try to be brief, is the office sector. And if we took two of the headline financial institutions that have become insolvent and traded most recently, either First Republic or Silicon Valley Bank, they're based in the San Francisco Bay Area. They cater to a lot of San Francisco Bay Area clientele. And there we see very, very hard hit office markets in San Francisco by virtue of the fact that the whole dynamic of the Bay Area has changed, the economic dynamic post-COVID. We've seen the dynamic of the tech sector change, and we see literally what we call see-through office buildings in the Bay Area, where the vacancy rates are very high. These buildings have great difficulty in cash flowing. That is, leases are terminated, leases aren't renewed, new tenants aren't found, and the reduction in cash flows moves just directly into lower office valuations. We have this thing called work from home. Work from home, as we all know, is not going away. It's not going away immediately. It's not doing anything good for these office buildings. So we have very, what I'd call distress level fundamentals in the office sector. And I want to address the residential sector as well. Shohini has touched on it. Chris has touched on it, et cetera. And there we have, Jerry as well, we touched on some very interesting things that are going on. Now, in the residential sector, we basically, to really break it down, have two types of mortgages. We have what we call conventional conforming mortgages that are essentially, if they conform to guidelines associated with the secondary market entities, Fannie Mae, Freddie Mac, or government entities such as Ginnie Mae or the VA or FHA or whoever, those loans are sold post-origination to those behemoths securitized, and funds for lending are replenished. And that securitization process takes place within a day or two, and those loans are off the books of financial institutions. So financial institutions are generally not holding those loans, but I think, as either Shohini or Chris said, Silicon Valley Bank was holding a portfolio of conforming mortgage-backed securities, and those securities were devalued in a higher interest rate environment. I'll get to that momentarily. The real interesting story, and the story of First Republic, has to do with the non-conforming loans, because post-2000 financial crisis, those loans can no longer be securitized. There's no longer a private securitization market. And those loans, and I'm referring here to loans at denominations in excess of about $1 million, loans that are called jumbo loans, are held on the books, or were held on the books extensively of First Republic, for example. Let me give you a few data points here, and I don't want to go on too long. Office prices, according to a very reputable firm, Green Street, are down by 25% since 2022. There's a REIT office property index by Bloomberg that's down 50% since 2021. We have a market, a private market for the sale and securitization of commercial mortgages. It's called the CMBS market. That market is almost frozen up currently, and issuance of new CMBS year over year in the first quarter was down by 80%. Regional banks hold about 14% of CRE debt, and just to give a few more bits and pieces of data, Silicon Valley Bank's holdings included in excess of $300 million in conforming mortgage-backed securities that were yielding to the bank something along the lines of 2.5% to 3%. So this goes back to what Shohini says, it goes back to what Chris said, it goes back to what you said, Lori. If Silicon Valley Bank is in a situation where deposits have fled, they're borrowing from the Fed at 5%, and their assets are only yielding 2.5% or 3%. They're quickly or immediately underwater. Now, in the case of First Republic, 3/4 of the assets of First Republic were $100 billion in non-securitized residential mortgages. And those mortgages had an average yield of 3%. They dropped in value by something like 20%. And again, this spells doom for First Republic. That plus the other factors I could go on here, but I think I'll stop and we'll take it up maybe as we go forward, Lori.
Thank you, Stuart. And I wonder what all of you think about. In the 2008 crisis, the big phrase was "too big to fail," and we have taken a lot of pains to monitor larger banks and insure them. But now we're creating even larger banks, right? JP Morgan was allowed to purchase First Republic. How concerned are you about what the market structure will evolve to through this consolidation as it relates to new risks for larger banks?
Well, I will say this. I think you cannot have an unequal playing field. You can't have everybody in the world know that the 5 largest banks are too big to fail. So if I put my money there, I'm fine. And then have the remaining banks in the country a game time decision, so to speak. And I think when we have a regulatory official come out and say, well, we'll determine whether we're going to cover those deposits based on systematic risk. That's not a calming thing to say to the average person who has their money in a bank, right? So I think it's got to be an equal playing field. And I think the answer is that if your deposits are in an FDIC institution, they should be guaranteed or they should be supported equally amongst a big bank or a smaller bank, or not supported. Whatever the rules are, they should be the same rules for everybody. I think that's really critical. And I think one of the things that Shohini mentioned earlier was also, if you're regulating the banks, I think you have to have a real-time, or at least as close to a real-time valuation of what their assets are. And marking these assets to market on a quarterly basis at the very least, I think is very important. Many of you may not realize in a bank that banks can hold their securities in 2 different ways: available for sale or held to maturity. If you hold your security, if you're a bank, you hold your securities available for sale, those are marked to market every quarter. But if you look between 2021 and 2023, how many banks shifted their securities, or at least put all their new securities into held to maturity so they wouldn't be marked, so to speak, against regulatory capital? It was a lot more influx into held to maturity because they're not marked versus available for sale. And I don't think that's really transparent to a lot of the investors out there. It's becoming transparent really quickly, though, I can tell you that.
If you look to the situation in Europe with respect to bank regulation and the matters that we're talking about today, you'll see that the situation is much closer to what Chris describes. And insurance is provided over a much larger range of banks, and surety and sort of equality of regulation and all the rest, so that there are concerning features of what's going on right now that are an artifact of our creation of this too big to fail situation with respect to only a small number of major institutions. And I know that there are proposals coming out of the FDIC as we speak, and maybe others on the panel wish to speak about them, that will hopefully clean up some of this. One of the proposals is to offer unlimited insurance to business checking accounts, regardless of institution. There are, we have an incentive structure currently whereby this massive growth in uninsured deposits is just incented to run away from the smaller regional banks and into these too big to fail institutions. And I think we need to rectify that.
Yeah, a couple of additional comments. One is that we have a very large non-bank financial sector. And, this current banking crisis points to additional regulation and supervision of our bank financial sector. But to what extent does that drive funds chasing yield into the non-bank financial sector where there's less regulation? And to what extent do we need to have oversight on all financial institutions? So that extends that a level playing field that Chris was talking about to the entire sector of finance. The second is there has been a disconnect in terms of policy between FOMC or Fed policy, which is looking at inflation and unemployment and regulation. So if the Fed is going to be raising rates as rapidly as it did they take into account the fact that there were going to be bank failures and too big to fail or moral hazard was going to come back into the picture? I think the answer is no. And so if there's a lesson to be learned, in addition to changing bank regulation, it's changing macro policy to take into account the fact that there's going to be interventions if you're going to do this kind of aggressive monetary policy.
Yeah. So thank you. So regulation and supervision are really top of mind for all of us. And Shohini, I'd like to ask you to dig deeper into this topic. I mean, we've seen that the Fed has admitted that their supervisor failed to take forceful action at SVB. The FDIC has admitted to mistakes. As Stuart said, there are new proposals from the FDIC, maybe around ensuring sort of commercial deposits so that businesses can fund payroll. Shohini, what do you think went wrong? You touched on it earlier, but if you can expand further on what you think went wrong with the existing frameworks for regulation and supervision, and what changes do you think are needed on the horizon?
Sure. So let me go back to the previous question, and then I'll talk a little bit more about regulation. I think there is a major concern that if there's outflow of deposits from small and regional banks to larger banks like the JP Morgans and the Bank of Americas of the world, you can create concentration risk. And essentially what happens is you're reducing competition by creating larger banking institutions that are too big to fail. The reason why this is problematic is that it raises concerns of moral hazard. So banks can be riskier, they can engage in riskier lending, because they know that if it's heads, they win. And if it's tails, then, well, the government bails them out. And all of us, by extension, are the losers as taxpayers. Now, I think the data shows two things that give, that kind of refute this trend and this major concern. The first is that, yes, outflows from small and regional banks did increase after the collapse of SVB. And there was greater inflow to larger banking institutions. But after the FDIC put the bank in receivership and the Fed also implemented new created backstops, then money had flowed back into small and regional banks. So it suggests that, people haven't lost faith in small and regional institutions. The second broader trend is that there's actually just been a general outflow of deposits out of the banking sector towards money market mutual funds and non-bank institutions. And this makes sense. If your bank is offering you a 0% interest rate and money market mutual funds are offering you something above 4%, then people are more likely to take their money out of the banking system and put it in money market mutual funds. So we have to recognize that, yes, financial intermediation consists of banks. Banks are a large percent of financial institutions, but there are also a number of growing players that are non-banks as well. And there are other types of funds. They are fintech companies, and they play a larger role in the economy. So now talking a little bit more about the regulatory side, the Dodd-Frank Act required banks between 100 and 250 billion to hold a sufficient amount of high quality liquid assets and comply with what's known as the liquidity coverage ratio, which essentially is a measure that tells you how well a bank will be able to weather a storm if they have to meet outflows. Now, the previous administration eliminated these rules for banks below 250 billion. And what they did is they increased the asset threshold for systemically important financial institutions, or SIFIs, and they increased it from 50 billion to 250 billion. So essentially what that meant is that banks, medium-sized banks like SVB, regional banks, didn't have the same obligations to undergo stress tests annually or comply with key liquidity regulation. And, as I mentioned before, even for the large banks that did get stress tested, the Federal Reserve didn't anticipate that rates would rise above 2%. And the highest interest rate that they considered was 2%, which is well below the interest rate today. So regulatory agencies should change the nature of stress tests. They should supervise banks, conduct stress tests on bank capital in an economic environment of stagflation. So the stress scenarios should take into consideration real market scenarios and the potential for rates to rise, as well as changes in economic conditions. They should conduct more rigorous stress tests on liquidity, which also considers the deposit franchise value of the banks. So far we've talked about how asset values can be affected by interest rate risk. But on the liability side, what's happening is that a lot of banks are losing deposits because individuals are taking their money out of the banking system or transferring it to other banks which have higher yields. And that essentially reduces the deposit franchise value of the banks, which can also put a stress on the banks as a whole. So regulatory agencies should enhance prudential standards for mid-size and regional banks. Now, the very clear takeaway from the discussion that we've had is that bank capital ought to be marked to market. Banks' balance sheets should provide an accurate assessment of the value of banks' assets, and they should recognize the losses when they occur. Now, part and parcel of marking your bank capital is also having banks increase their capital buffers. If you increase the capital buffers of banks, it can stabilize the banking system and make sure that when things go poorly, there's sufficient capital on hand so that your depositors are not being affected. And one way banks can do this is they can raise equity in the market. So when banks raise equity, households can buy that equity and essentially move money away from deposits. So bank capital is one form of private depositors insurance by essentially creating a larger buffer so that if things go poorly and banks experience losses on their asset side, it's not going to eat into the deposits on their liabilities. And then lastly, I think there should be more research and consideration of the optimal design of depositors insurance, which takes into consideration the fiscal limits of deposit insurance. Now, many people say that, well, the government should insure all deposits and the government has an obligation to all depositors. Now, a question that comes up on the other side is, well, if the government insures all deposits, then banks can do whatever they want. They can take as much risk as they want with the depositors' money. And that can also essentially transfer the risk of the banks to the government. So I have some research that examines moral hazard arising from depositors' insurance schemes, but I think there's certainly more to be studied here.
Thank you.
I think a counter to that a little bit, Shohini, is if they did say, hey, we're going to guarantee all the deposits, if you were marking the assets to market, at least you'd have information, short-term information that was relevant into a bank that was trending negatively and so forth. And I think the government has been very slow on the trigger at times to go ahead and seize a bank. And maybe the triggers to seize a bank should be accelerated by the government, so to get it before it becomes too much of a problem. And that's another thing that could be looked at as well.
One of the difficult features, and I agree fully with what the other two panelists have indicated with respect to mark-to-market of bank assets. One of the difficulties, for example, in the office market, as I was just speaking about, is the fact that we've had very, very few transactions. And it's been very difficult to get at real valuations in this particular market. I mean, you can get at those valuations indirectly and perhaps without great confidence via, some guess at capitalization rates and the like. But that notwithstanding, it's only now that we're beginning to see the office market clear. It's only now that we're beginning to see the losses recorded. And what we're being told in the current or present tense is that a lot of the pain in the office sector is still in front of us. And so a lot of risk remains with respect to entities, be they bank entities or non-bank entities that hold these particular assets or hold commercial mortgage-backed securities associated with these assets or hold commercial mortgage debt associated with these assets. And this is a reason we may want to see, among others, the Fed take a breath and take a look at how deep all of this dislocation is going to be.
So to close, I'd like to ask each of you one of the most pressing questions that's on everyone's mind right now, which is basically, are we heading for another version of the 2008 crisis? Kind of what lies ahead? We'd love to hear from each of you. Maybe Shohini, if you could start.
I can't say much to whether we're headed towards a 2008 recession, but I can say that we can't wait for things to get bad enough before we take action. And I think, there are a number of changes that ought to be implemented to at least reduce the risk that we enter a recession 2008 style.
Thank you. Jerry, thoughts?
So this is a tough question, but I think the answer really lies in what is it that we don't know about the banking sector now? What is at risk? At present, it looks like it's under control. But I think the answer is that the regulators need to dig deeply and rapidly to see what measures ought to be put into place, if any, to prevent a 2008 financial crisis. So far, it looks like not, but we're just looking at the surface.
Mm-hmm. Stuart?
The situation now is entirely different from 2008. It's clearly not the same set of issues. It's not the same set of securitization issues, et cetera. But that doesn't mean we don't have downturn risks here. We have real downturn risks. And again, I would come back to the potentiality that the Fed will overshoot. And they will overshoot because, again, of these long and variable lags and because of a difficulty in appreciating the full magnitude of tightening that's taking place in the banking sector and elsewhere. And there are many, many anecdotal reports that relate to that particular tightening. So the jury's not in yet. The recession risks remain. And I think, again, there's pain to be recognized. And just one more word, the commercial real estate mortgages are typically short in term and need to be refunded with regularity. Lots of these mortgages are already underwater. And when they come up to be refunded, they're going to be refunded potentially at double the rates at which they were previously originated. And there's no opportunity for refunding unless the borrower has more skin to put into the game. In other words, more equity to put into the game. And barring that equity, we're going to see a lot of pain. And that pain is in front of us.
Chris?
All right. I think that I guess we all really don't know, but I think one thing is materially different than was 2006, 7, 8. When we say 2008, I look at the years running up there as been the years of real sin, if you will. And we don't have the leverage in the economy that we did then. They're highly leveraged balance sheets and so forth, not as leveraged. But, leverage increases when asset values go down. So that leverage could shift and change a little bit over time. And I do worry about fundamentally, remember, banks take their money in short and they lend long. Inverted yield curve, it's like there's no incentive for the banks to lend. And so what I think is going to slow down the inflation rate, in as much as the Fed is trying to bump rates to cool it off, I think the lending aspect, the banks hunkering down and not lending much money out the door. Plus, banks are losing deposits, so they really can't lend money, right? Unless they want to go borrow money at 5%, the Federal Reserve, and then lend it out at 7 or 8%. That's not enough margin for them. So I do think that the banks lending is going to slow down considerably in the next 2 quarters. And it lags a quarter too before everybody realizes what's going on. So I think you're going to see later in this year I think you're going to see that is as important as anything the Fed's going to do, is the banks are going to slow down, not completely stop, but drastically slow down lending.
Okay. Well, on those ominous notes, I want to thank all of you for this fascinating discussion, and thank everyone in the audience for joining us. What can we say? Be well and stay stable, and we'll see you next time.
Thank you, Lori.